Welcome to another episode of the Wealth Frequency Podcast.
Because wealth isn't just money, it's a mindset.
Today, we're doing a deep dive into a really influential book, Robert Kiyosaki's Rich Dad, Poor Dad.
Yeah, it's one of those books that, really gets people talking, rethinking things.
Definitely. So our mission today really is to pull out those key ideas about money. What the rich supposedly teach their kids that maybe others don't learn.
Right. Trying to understand those foundational principles of wealth building and financial thinking that he lays out.
Exactly. We're going to walk through it chapter by chapter, share some reactions, maybe some insights, all aimed at helping you, the listener, get a better handle on your own financial future.
Sounds good. It definitely challenges a lot of conventional wisdom. And right off the bat, he introduces those two father figures, which is quite the setup.
Okay, let's jump right in then. Chapter 1, Rich Dad, Poor Dad. It really sets the stage with these two, dads, holding completely opposite views on money.
It's like, night and day. You've got the poor dad, highly educated, but financially maybe not so secure.
Mm.
And then the rich dad, less formal education, but street smart about money.
Yeah, totally. And you see it immediately in their core beliefs.
Yeah.
One says, the love of money is the root of all evil.
And the other, the lack of money is the root of all evil.
Wow. That contrast hits you straight away. For the listener, it kind of forces you to ask, okay, what are my beliefs about money?
Exactly. Are they helping or maybe, holding you back without realizing it?
And having these two different models, like Kiyosaki describes, it forced him to think critically, didn't it? He couldn't just accept one way.
No, he had to weigh them up, think about the results of each philosophy, and then sort of choose his own financial path.
Which leads to one of the book's big arguments. This idea that the rich tend to get richer while the poor and middle class can struggle.
Right. And he pins a lot of that on financial education or the lack of it. He argues it's taught at home in wealthier families, but often missed elsewhere.
Where the focus is usually just on school and getting a good job.
Yeah. So, you might ask yourself what money conversations happened or didn't happen when you were growing up.
That's a good point. Think about school. Loads of time on job skills, but how much on, managing money, investing, making it grow?
Almost none, usually. And the book suggests this gap is a huge factor. Even for people earning good salaries, they might still lack that financial literacy.
It's not about being smart in general. It's about being smart with money specifically. And the rich dad really pushes financial self-reliance, right? Not waiting for handouts.
Definitely. You see it in the advice. Poor dad. Save money, write a good resume, find job security.
Rich dad, learn to invest, write business plans, create opportunities. Very different approaches. Are you mostly saving or are you actively investing?
And chapter 1 really wraps up by hammering home the power of your thoughts. Kiyosaki saw how his dad's beliefs shaped their lives.
Yeah, your mindset about money really does seem to create your reality, according to the book.
Okay, chapter 2, lesson 1. The rich don't work for money.
Right. This starts with young Kiyosaki and his friend Mike wanting to make some cash.
Mm-hmm. And their first attempt is pretty creative, if slightly illegal, melting down toothpaste tubes.
Yeah, to make fake nickels, right. But what's interesting is the poor dad's reaction.
Even though it was, counterfeiting, he apparently praised their ingenuity and told them not to give up after failing. Shows a difference in viewing setbacks.
True. But then comes the real first lesson. From Rich Dad.
The job offer. 10 cents an hour.
Yeah, working in a shop. And Robert gets bored, frustrated, wants to quit almost immediately. Low pay, menial work.
But that low pay was the whole point, wasn't it? It wasn't about the money.
Exactly. Rich Dad wanted to teach the difference between working for money
and having money work for you. That's the core lesson here.
Right. Rich Dad says school teaches you to be an employee, trading your time for a paycheck. He wanted to teach them how to generate income from assets.
So, are your income sources just from your own labor? Or do you have things working for you?
And then he gets into the psychology, the role of fear.
Oh, yeah, that's big. Fear keeps people stuck in jobs they might not even like. Fear of bills, losing the job, not having enough.
Fear of starting over, too. It keeps people tied to that paycheck.
He calls it being a slave to money and points out how people might resent their boss, but it's the fear that's really controlling them.
Plus, the government gets its slice first through taxes, right? You earn, you spend, you save, you die. Taxes are always there.
It makes you think how much you actually keep after everything's taken out.
And this leads to that key conversation, the one at the picnic table about one of life's biggest traps.
He paints this picture. Work hard, low pay, Cling to job security, live for tiny vacations, and maybe a pension that isn't enough.
Does that sound familiar to anyone listening? It's a bit bleak, but maybe relatable.
And he says emotions, mostly fear and desire, drive people into this trap. Fear makes you work, hope the money will fix the fear, but it just continues.
Yeah, the cycle repeats. He really warns against letting money run your life and trusting too much in, like, job security.
Which he argues is largely an illusion anyway.
He uses that briar patch idea for fear and greed and says the way out is using your head, choosing your thoughts, not just reacting emotionally.
And the tar baby analogy, getting stuck to the fear of not having money so you can't move or take risks.
Which is why they agree to work for free, to learn, not for the wage, but for the education.
Right. Rich Dad basically promises their minds will open up to other ways of making money once they stop focusing only on the paycheck, moving from scarcity to possibility.
And boom, their next venture, the comic book library.
Genius. Using comics they couldn't resell, putting them in a room, charging admission.
And Mike's sister ran it right, so it made money even when they weren't there.
That's the key. Their first taste of passive income. Money working for them. Controlling their finances, not just being employees. Foundational stuff.
Okay, Chapter 3, Lesson 2. Why teach financial literacy?
This one starts with a pretty sobering story, doesn't it? Those super rich guys from 1923.
Yeah, who mostly ended up broke, or worse, just a couple of decades later. It really drives home that making a lot of money isn't the same as keeping it or understanding it.
Exactly. It's a wake-up call. Earning isn't enough. You need to know how to manage it. And he uses that skyscraper analogy. You need a solid foundation before you try to brew wealth quickly.
So what's the foundation? Rule number 1.
Rich people acquire assets. The poor and middle class acquire liabilities that they think are assets. Simple, but profound, maybe.
Deceptively simple, yeah. Because he argues most people get it wrong. Is the thing you're buying putting money in your pocket or taking it out?
And the definitions are crystal clear.
Yeah.
Asset dot money in. Liability dot money out.
Mm.
Understanding that difference is like the whole game, according to Rich Dad.
He even uses those simple diagrams, income statement, balance sheet, not as scary as they sound, just showing where money comes from and where it goes.
Right. Income statement is the flow, balance sheet is the snapshot, assets feed income, liabilities drain it.
And the examples help. Assets, rent, dividends, interest, royalties, maybe certain real estate or stocks.
Liabilities, mortgage on your own house, car loans, credit cards, stuff that costs you money regularly.
The key idea is that the cash flow tells the real story, not just your salary number. Where does the money actually go?
That's crucial. People think, if I just earn more. But Kiyosaki argues, without focusing on assets, more income just means more spending, more liabilities.
It's about what you do with the money you make. That's financial aptitude, right? Keeping it, making it grow.
Which explains why even smart, high-earning professionals can struggle. They might not understand cash flow.
And that brings us right to the rat race.
Oh, yeah. Income goes up, lifestyle goes up, expenses go up, debt goes up. You're running faster, but staying in the same place.
And taxes are a huge part of that race, often underestimated. Social Security, Medicare, income tax, it comes off the top.
You have the bigger house, the nicer car, often bought with debt, which increases your liabilities and keeps you needing that job.
The book mentions the fear of being different, too. Sticking with the crowd financially, even if it's not working.
Right, and missing opportunities because all your money is tied up in things that cost you money, like maybe your primary home.
So the core message, the rich focus on building that asset column. Assets generate income, pay expenses, get reinvested. It snowballs.
While the middle class often relies solely on salary, increases spending with raises, and maybe sees their house as their main asset.
Which the book argues is risky and leads to debt and insecurity, especially if jobs disappear or pensions aren't stable.
And it all comes back to that lack of financial education early on, forcing people to play it safe because they don't have a strong asset base.
So just earning more mainly benefits the taxman, the bank, the creditors.
Unless you shift focus from just a bigger paycheck to actively building assets that benefit you.
Okay, Chapter 4, Lesson 3, Mind Your Own Business. Starts with that Buckminster Fuller quote about wealth.
Yeah, how many days could you survive if you stopped working today? That's a different way to think about wealth, isn't it?
Totally. It's not just net worth, which can be misleading. It's about cash flow from assets versus your expenses, real independence.
Like his example, $1,000 a month from assets, $2,000 in expenses. You have half a month of wealth. Get asset income to $2,000, then you're wealthy by that measure.
And this ties into the difference between your job, your profession.
And your business.
Mhm.
You could be a banker, that's your profession. But owning the bank, that's the business.
So minding your own business means focusing on building your asset column. That's your real business, not just your job.
Right. He argues that working your whole life just building someone else's business, your employers, is why many people struggle.
Like those people who get laid off and realize their house and car don't pay the bills. They aren't income-producing assets in a crisis.
So the advice is practical. Keep your day job. For now, anyway.
But start building. Start buying real assets on the side.
And he defines those again. Businesses you don't have to run day to day.
Yeah.
Stocks, bonds, income-producing real estate, intellectual property, stuff like that.
Things that generate cash flow.
Exactly. He does caution about jumping into starting a company, unless you're really passionate and prepared, because many fail.
The main point is building and protecting that asset column. Money goes in, you try not to take it out, let it work.
Like an employee working 24/7 for you, even for future generations. That's a powerful image.
And then the point about luxuries.
Ah, yes. Rich buy luxuries last, with asset income.
Poor and middle class often buy them first, usually on credit, wanting to look rich but getting into debt.
The example of Kim buying her Porsche after her assets could pay for it. It wasn't just about the car. It was about the financial engine behind it.
Which leads perfectly into the biggest secret of the rich.
Understanding corporations and taxes.
Chapter 5, Lesson 4, The History of Taxes and the Power of Corporations. Kicks off by kind of debunking the Robin Hood idea.
Yeah, arguing that the tax the rich idea historically ended up hitting the middle class the hardest. That might surprise some people.
It's a different take. He gives a quick history. Taxes start small, target the rich. Government spends more, needs more revenue.
So taxes expand downwards. And how did the rich respond, according to Kiyosaki?
Corporations. Using that legal structure. Originally for limiting risk, like on shipping voyages.
But it evolved into a tool for asset protection and, crucially, tax efficiency.
The key is that a corporation is a separate legal entity. It's not you. Your personal stuff is shielded to a degree.
Right. And the book argues this gives the rich an edge because corporate tax rates can be lower, and importantly, you can pay legitimate business expenses before taxes are calculated.
So you spend pre-tax dollars on things related to the business, lowering the taxable profit.
He suggests the rich basically use their knowledge of these structures to navigate around rising personal income taxes, financial literacy as a defense.
And the cycle continues. Government taxes, spends, needs more taxes, goes after lower incomes again.
While the corporation, just a legal filing really, offers protection. It's this ongoing battle over rules and money.
And the folks who just work, pay taxes, and don't understand the system, they're the ones who potentially lose out.
Yeah, the rich don't just sit there. They adapt, find legal ways to minimize the burden. It's a contrast to poor dad's just get a good job advice. Rich dad's view: be smart, know the rules, don't just get pushed around by the system, use the law.
He uses that analogy of the employee being like a cow ready for milking via the paycheck withholding system. A bit harsh, maybe, but it makes a point.
And Kiyosaki shares his own story, right? Starting his first corporation while still working at Xerox.
Yeah, his first step in minding his own business, seeing firsthand how deductions work differently for a business.
The argument's clear. A corporation can help you build wealth faster than just being an employee or sole proprietor because of these potential advantages.
Things like legitimate business travel, car expenses, maybe even health costs, potentially paid with pre-tax dollars, legally, of course.
It boils down to that different sequence. Business owner, earn, spend, business.
Yeah.
Pay tax. Employee, earn, pay tax, misspend.
So the recommendation is pretty clear. Learn about these legal structures as part of your overall financial strategy.
Okay, Chapter 6, Lesson 5, The Rich Invent Money. This one feels a bit more advanced, maybe.
Yeah, it pushes the thinking. Starts with that story about the cash flow board game.
Right, and the woman who just didn't get it wanted simpler answers.
But the game's point, he says, is to teach how the income statement and balance sheet interact, how to increase cash flow from assets. It's like a financial simulator.
And games show your behavior, right? They give instant feedback on your choices. Cash flow is meant to do that for your financial habits.
He observed that the players who got out of the rat race fastest in the game were the ones who understood numbers and thought creatively about finance.
Yeah, they saw options others missed, unlike those who in the game and maybe in life just wait for the perfect deal or don't have money when a deal appears or only know how to work hard and save.
The message seems to be increase your financial IQ and you can create your own luck, make opportunities happen.
Which leads to the idea of inventing money. The example he gives is buying that $60 K house for $40 using notes and mortgages creatively.
Right. It sounds complicated, but the point is using financial tools strategically.
And in that example, $40,000 is created in the asset column, potentially tax deferred, and starts generating cash flow.
And doing this through a corporation can amplify the benefits using the income for pre-tax expenses.
He then asks those challenging questions. How long to save 40K or 190K? Can you get 10% interest from a bank?
It highlights the potential speed difference between actively creating deals versus just working and saving, especially after taxes bite into savings interest.
Yeah, it's about ROI. Getting paid to structure a deal is smarter financially than earning tiny taxed interest.
And market changes always create new opportunities if you know how to look for them, so it's a choice.
Work hard, pay lots of tax, save what's left at low interest, or develop financial intelligence and leverage assets.
It circles back to poor dad's focus on grades versus rich dad's focus on real-world financial smarts.
And he lists those 4 technical skills again: financial literacy, investing, understanding markets, and the law, accounting, corporate rules, taxes.
He shares another story, buying a problem house cheap, fixing it, renting it, then selling for a big profit, using a 1031 exchange to defer taxes and reinvest.
Showing how knowledge lets you handle complexity and risk for potentially higher rewards. Safe investments often mean low returns.
The more you know, the more deals you see, the better you can judge them.
He even mentions his riskier plays, like a stock portfolio in a corporation, investing in speculative private companies.
But he's careful to say that's high risk, not for everyone, just an example of what's possible with expertise.
Because great opportunities are seen with the mind, not just the eyes, which leads to the 2 types of investors.
Type 1 buys packaged investments, mutual funds, REITs, etc.
Type 2 creates investments. They assemble the deal.
And that requires 3 extra skills, he says: finding overlooked opportunity,
Raising money, not just relying on banks.
and understanding and working with people, managing the deal.
Like the friend who bought the rundown house and found extra lots nobody noticed. Huge profit from seeing what others missed.
And learning how to raise capital is key, not just saying, I don't have the money.
Right. Type 2 investors figure that part out, like tying up a property with a contract before having all the cash lined up.
Then there's that great story about the author. Master's in English Lit, brilliant writer.
But struggling until she learned sales. Became a best-selling author, not just best writing.
It shows how combining skills is powerful. Many talented people under-earn because they lack one key complementary skill.
One skill away from great wealth. That's a powerful phrase.
And it supports the idea of learning broadly, not just specializing too deeply, too early, like the Marine Corps approach he mentions.
Contrasting with the educated dad's focus on job security through specialization.
Rich Dad's view was different. Learn about trade, markets, leadership, managing people, broader skills.
Which brings back job. Just overbroke. If schools don't teach financial intelligence, people stay stuck.
So the advice for young people: work to learn, not just to earn. Focus on skills, sales, marketing, communication.
Avoid being like hamsters on a wheel, just paying bills. Maybe take a second job purely to learn a new skill, like sales through network marketing, he suggests.
Because education, especially financial education, is more valuable long-term than just money.
Like going to the gym takes effort to start, but builds strength. Same with financial muscles. And management skills are crucial: cash flow, systems, people, especially sales and marketing.
Okay, Chapter 7. Lesson 6. Work to learn, don't work for money. This hits on fear again. Fear of losing money.
Yeah, he acknowledges it's real. Everyone feels it, even the rich.
But the difference is how you handle that fear and how you handle failure. That's what separates people financially, he argues.
He uses the Alamo example, how winners can take a defeat and turn it into motivation, learn from it.
Like learning to ride a bike, right? You fall, you get back up, you learn. Failure is part of the process.
But cynics, he says, are often just paralyzed by fear and doubt. The chicken little syndrome, the sky is always falling.
He lists common self-doubts people have, or things others say, that stop them from acting.
Like that friend who backed out of a good deal because his non-investor neighbor said it was risky. Fear won. Buyer's remorse before even buying.
Or people avoiding something like tax liens because they sound scary, settling for tiny CD returns instead. Doubt costs money.
Focusing on the I don't want tenants, I don't want to lose money, stops people from figuring out how to get what they do want.
The Colonel Sanders story is great here. Success after so many rejections, tenacity overcomes fear.
Then he talks about laziness, but not just sitting around. Busy people can be lazy
How so?
by avoiding the important stuff, avoiding strengthening relationships or health, or crucially their finances, because it feels hard or uncomfortable. They stay busy with less important things.
Interesting point, which ties into pay yourself first again.
Right. Put money into your asset column first. He argues this forces you to be more creative and disciplined about covering your other bills. It creates positive pressure.
Like building those mental money muscles. Makes you stronger, less afraid of financial challenges.
The final barrier he mentions is arrogance, thinking you know it all.
Which stops you from learning, right? If you think you're already an expert.
Exactly. Arrogance often masks ignorance, he suggests. If you don't know something financially, admit it. Find an expert. Read a book. Educate yourself.
Good advice. Okay, final stretch. Chapter 8, Getting Started.
Begins with, there is gold everywhere. Most people are not trained to see it. Kind of optimistic.
Yeah, suggesting opportunities are out there. This chapter's about action. It says financial success isn't just making money, it's knowing how to keep it, how to manage it.
And it tackles why more people aren't rich, suggesting it often comes down to choice. Limiting beliefs, excuses that eat up time and stop learning.
It really emphasizes choice, choosing daily to invest in knowledge, invest in assets, and choosing your friends carefully.
Yeah, surrounding yourself with supportive, knowledgeable people makes a difference.
Then there are the 10 steps to awaken your financial genius. Practical stuff.
Like finding a strong why, a reason bigger than just comfort.
Making those daily choices.
Right. Choosing friends, like you said.
Mastering one formula before jumping to the next, like his foreclosure class example. Focus first.
Pay yourself first. We've heard that one. Crucial. Showing the cash flow diagrams again.
Pay your brokers well. Value good advice.
Be an Indian giver. Focus on getting your initial capital back. Then the rest is gravy. Assets for free.
Use assets to buy luxuries, not debt. Like the friend wanting a car guided to investing first.
Choose heroes. Learn from successful people. Warren Buffett, etc.
And teach, and you shall receive. Sharing knowledge reinforces it, brings opportunities.
Then there are even more specific to-dos. Go to seminars, listen to audio, get mentors.
Take classes, read, make lots of offers, overcome fear by doing.
Shop for bargains. Profit is often made when you buy. Think big, look for volume, learn history.
It's very action-oriented. He ends with that story about helping a friend use college fund money to buy wisely in a down market.
Which then grew significantly and provided income back to the fund. Shows applied intelligence works.
The final message really hammers it home. Financial intelligence is vital today. It takes money to make money, is old thinking.
Money is just an idea. Change your thinking. You can change your finances. Start small, practice, learn. He mentions turning $5K into $1 million asset, generating $5 a month in 6 years.
It's possible, he implies, with the right mindset and knowledge.
And that final quote, it's what is in your head that determines what is in your hands. Learn to have money work hard for you. Today, don't play it safe, play it smart.
Whew. Okay, that was a pretty thorough walkthrough of Rich Dad, Poor Dad. Lots to digest there.
Definitely. We covered the main lessons, hopefully giving listeners a good feel for the book's core ideas about shifting your financial thinking.
And obviously there's more nuance in the book itself, but hopefully this gives a solid foundation.
Absolutely. And, a logical next step for anyone interested might be looking into his cash flow quadrant concept.
Right. That breaks down income sources. E for employee, S for self-employed or small business.
B for big business owner, and I for investor. It's another useful framework he developed later.
So we definitely encourage listeners to grab the book, read it fully, and really think about how these principles might apply to their own lives, their own financial journey.
Yeah, it could be a real catalyst for change, for taking control. It certainly sparked a lot of debate and action over the years.
Well, this has been great. Thanks for joining us on this deep dive. Hope everyone found it valuable.
My pleasure. Always good to revisit these foundational concepts.
Thanks for listening to the Wealth Frequency Podcast. Stay tuned for another great book.